Hello, everyone. This is Bill Fairman with Carolina Capital Management. We are broadcasting live from the back of my office with my good buddies, me and Muhammad Ali. We have a great guest coming up. We're going to talk about self-storage and the current market, and we'll get to that right after this. Greetings. Thank you so much for joining us on the Real Estate Investor Show, Hard Money for Real Estate Investors. We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you are a borrower and you're looking to fund your project, go to Carolina Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell. And don't forget Wednesdays with Wendy. Wendy dedicates 30 minutes per person on Wednesdays to talk about anything real estate related. You will have to get on her calendar. She's usually booked out a few months in advance. Summer is going to be even tougher because Wendy also likes to take time off every now and again. So she's going on vacation soon. So get signed up on her calendar. Also, we are going to be in a couple of places. Hey, Wendy. Quest Expo is coming up. And if you go Fairman30 as a code, you can get 30% off your tickets. There it is right there. Go to the link and Fairman30. You could probably do that with Suite 32, can't you? You need to turn your microphone on, Wendy. It's okay. I love to see your lips move, though. Still can't hear you, but that's all right. We'll work on it in a little bit. Folks, we have a comment section on the right side of your screen or underneath, depending on the platform that you're viewing us from. So if you have any questions, comments, concerns, don't hesitate to voice those. Okay, so we're having a topsy-turvy ride right now. Rates are rising. Inflation is high. The market is, we'll call it correcting itself. I'm not going to throw the breaking news banner up, but yesterday we had the biggest loss, one-day loss in quite a long time. That said, when money gets tighter, then those value stocks start dropping. That's why it's very important to be in assets. And we have our good friend Fernando Angelucci with us today. He's been a guest many times. He's an awesome guy. He's in the self-storage space, and we're going to bring him on now. There he is. How you doing, Fernando?
I am doing wonderful, Bill. I'm in Colorado Springs right now at the base of the Cheyenne Mountains, so coming to you from my hotel room at the moment.
Well, listen, I appreciate you joining us.
Sure.
While you're out of town like that as well. You have actually pretty good camera spot there. Hotels are tough trying to find the right place where you don't look like some kind of shadowy figure that you're trying to hide when you're in, what do they call that?
I don't know. Bill's mind is like in slow-mo right now. He's frustrated because we couldn't get online. We've got a computer that decides to turn off by itself all the time. And I think it's going to end up against the wall here real shortly.
No, it won't, because it's a brand new Mac. Witness protection. That's what I was thinking. Sorry. Next, we're gonna get your voice and make it sound like one of those funky voices. So
yes.
Luke, who is Fernando, I wanted to have you on today because, in a rising rate environment, you're typically, when you're purchasing rental assets, whether it be multifamily or self-storage or single-family homes for that matter, if it costs you more as a owner to own the property, how differently, are you looking at the numbers? And I wanted to get your perspective on how things are changing, or maybe not so much, because frankly, the value of the property doesn't change any way, even though the financing for the owner may change. The values are still there. You're still getting the same returns, but reality sets in, and if it costs you more to own it, what do you do? How do you look at things? So I'm going to shut the heck up and let you talk now.
Yeah, I appreciate that. So in general, when we're looking at income producing assets, we want to make sure that we're making a solid spread over our debt cost. So, as we all know, interest rates have gone up about 0.75% in the last month or so. Because of that, we've had to increase not only our going in cap rate when we're purchasing, but then also our exit assumptions as well. So you always want to make, we shoot for a 300 to 400 basis point spread over our rate. So if we're, locking in nowadays, 4 3/4 or 5% debt, that means that we're trying to buy these things at anywhere between 8 to 9% cap rates going forward. Same thing with the exits. Originally we were assuming 6.5 to 7% exits on a lot of these assets 3 to 5 years down the line. Now we're pushing that up to 7 to 8% exits, depending on the grade of the asset. If it's a cash flowing property, typically we're buying Class B, Class C properties in secondary and tertiary markets, so they trade at a little bit higher of a cap rate versus the Class A REIT grade developments that we do. They, up until recently, they were trading at 4.5%, 5%. So now we're assuming 6 to 7% exits on those Class A builds.
So just remind me, when those cap rates are higher, the values are a bit lower, correct?
Correct. Yeah, correct. Mm-hmm.
And part of the reason they were trading at such low cap rates, I think, in my personal opinion, and you can chime in, is because there was a lot of cheap money out there, and we were having the same issue that the value stocks are having in the stock market, is that this is really an actual asset that is earning an income, but I can't think it was kind of a bleed over from all the free money that was out there, right?
Yeah, absolutely. I mean, in our industry, the self-storage space, we saw a lot of these larger operators, the top 10 operators in space. These are the REITs that you see on every corner, Extra Space, Life Storage, Public Storage, U-Haul. We saw them buying some pretty aggressive portfolios. So for example, Extra Space, they closed like a sub 4% cap rate portfolio deal. I think it was like 3.5%. And then you wonder, how can you make money on this? But then when you actually explore how their capital stack was situated, it made a ton of sense. So they went over to Europe, where there was negative real interest rates, and they offered a $500 million bond at 7/8%, and they got it fully subscribed, mixed with, I believe they had debt in the low 2s. So their blended cost of capital was something like 1.8%. So when they buy a 3.5% cap rate portfolio, they just effectively doubled their money on that deal.
Wow.
Obviously I'm not a multi-billion-dollar company, so I can't get that type of debt or that type of equity. But on our side, up until recently, we were getting 3 3/4% interest rates, 4% debt, even on ground up deals, which are considered riskier than, say, a existing property that has historical cash flows. So that's been going up quite a bit. Like I said, we have 9 active projects right now. A lot of those projects, we're potentially looking at debt in the 4.5 to like 5.25 rate range nowadays because of that 0.75% increase over the last 2 raises, or the last 2 Fed fund raises.
Excellent. We personally have been getting into the self-storage business thanks to you.
Finally.
Yeah. Wendy, I know you got a ton of questions to ask, because actually Wendy has been running point on these projects.
Actually, I don't have a whole lot of questions. I'm ready to hang myself, but no, I'll tell you. In fact, I've got these sheets in front of me. Here's what's really funny. The one that we just bought in Tennessee, this is how they keep up with their customers. It's not even on a computer.
Right.
It's here. I'll show a better picture. It's amazing. Everything's on a yellow legal pad, but you know what? They're the perfect people to buy from. It was just so poorly managed. It's crazy. We've cleaned out 18 units that were over 4 years unpaid. Just that last week, and doing the final ones this week. So it's amazing. You might imagine that the cash flow will certainly increase there. And I mean, the locations are great. So I'm thrilled about that, but gosh, it's exciting to go through and frustrating to go through, but things are so automated now in every way that you either jump on the train or give it up.
Right.
It's just amazing. Their gate hasn't even worked for 3 years.
Those are the type of value add deals that you want to get into, especially if it's going to be, your first or second facility, because there's a lot less risk than, say, building a storage facility that may take 2 or 3 years to cash flow. You have historical cash flows. You can compare it to, current competitor market rates. And just by bringing that facility into the 21st century, there's a lot of value to be gained. Like you said, moving everything from yellow legal pads to a self-storage software, using automation to allow them to rent and to get unit locks and be able to pay their bills online with a credit card or a debit card. I mean, that's where a lot of the money is made in these Class C, Class B properties in these secondary and tertiary markets.
Yeah, no doubt. The other thing that I absolutely love, and that we're able to add in both the facilities that we purchased, is RV parking. It's crazy out there. I'm seeing more and more facilities that are just dedicated to RV and boat parking.
Yeah, I think that's a very interesting assumption that you have there. So right now, because of the pandemic, a lot of people couldn't travel. And because of that, they were buying boats and RVs because they would have to do vacations, nearby, basically. So that caused this massive demand for boat and RV storage. I mean, anecdotally, I have friends where they'll literally drive 2 to 3 hours away from the lake that they're bringing their boat to, just to find a place to store their boat.
Right.
Now, with that being said, I do want to give a word of caution to those out there that are thinking of doing 100% dedicated boat and RV. You got to realize this is an extremely luxury asset, and it's one of the very first things to go away in tough times and recessionary environments. So, we're personally not doing any 100% boat and RV. It is a good addition to a self-storage facility, but as we've seen in the 07 to 09, the 2001 crash, the 1990 crash, 1991 crash, boat and RV right towards the top of the economy, it's doing really well. And then, poop hits the fan, and then all of a sudden everybody's trying to sell their boat and RVs. They're trying to get rid of the spots because they don't want to pay. I mean, in some places, we're seeing people pay $400 to $600 a month just to park their boat or their RV on gravel with maybe a canopy over it. I mean, it's ridiculous.
That's crazy. So we were at the Inside Self-Storage event. They've got one there in Las Vegas. The Love's Trucking is who put that out there. And it's all RV and boat parking. They have the T hangers with solar on the roof, so they get a 30% tax abatement on that. And then there's no walls. So, how is the local government going to tax that? Is it going to be improved or not? You know, there's a lot of extra things you can get out of that. But one of the things that I really like about, especially our Tennessee property, is Fairfield Glade, which is one of the largest retirement community conglomerates that are out there. They've got a really big, I guess we could call it a neighborhood out there, and there's actually two that are there. So, it's the retirement community that's really has purchased all those mobile homes or motor homes, I should say, and campers. Right. So I think we're in a good position.
Well,
I agree.
I like your point about not setting up something that's dedicated just a boat and RV, because you have choices when it's not dedicated. So if you have the space to expand for that, and you get to a point in the economy when people start selling those assets because they're too expensive to keep up with, then you can always put mobile units, storage units in there to take their place. And
that's right.
So now you have more income producing actual units. And then, you know what, top of the market, you could always sell off those mobile units and put the boat and RVs back in. So
that's right.
You still change with the time.
What was it that really attracted you to the self-storage world in the first place?
Yeah, 3 words: no tenants, no toilets, no trash.
Yeah.
I mean, in all honesty, there's so many reasons why we got out of habitation-based real estate. There's this trend we're seeing in the United States of this kind of socialization of rental housing, where now the government is getting involved in, private investors' lives and investments, because it's unfair that, somebody didn't plan and all of a sudden now has no income and they can't pay their rent. So it's a much easier way to get votes when you say, hey, you don't have to pay your rent, we're not going to kick you out, and you're not going to have a roof over your head, as opposed to saying, you have a self-storage facility, if it gets auctioned off when you don't pay your rent, it's not like you're going to be on the street, right? So much less press. Yeah. So much less negative press. Again, as far as the legal side of things are involved, instead of it being guided by rental landlord tenant law, you're actually guided by property or lien law, which means when you put your possessions in one of my storage units, you're automatically giving me a lien against your possessions if you do not pay. So I don't have to go through the eviction process. And as we all saw in this most recent pandemic, depending on what cities you're in, there was evictions were paused for almost 2 years.
Right.
So, okay, great. The tenant doesn't have to pay rent. They don't have to leave. But then how about the landlord? Everyone thinks that landlords are these hyper wealthy, conglomerates, but the real situation is that most landlords are just small operators.
Right.
The majority of landlords in the United States only have 1 or 2 rental properties. Right. So, and they're only 1 or 2 months ahead of the rent payments on their mortgage. Mm-hmm. So can you imagine the blowout that eviction moratorium and foreclosure moratorium caused for landlords in the space? I mean, now that both are being lifted, you're seeing a lot of investment properties hitting the market because these guys are so far behind on their mortgage payments and they couldn't make it up.
Right.
Luckily for a lot of those landlords, this time the pricing of those assets were pretty high, so they were able to get out without being underwater. But I mean, can you imagine all this work that you put in to buy rental housing? Then the government says your tenant doesn't have to pay their rent for 2 years. And then all of a sudden now that affects your credit, which is going to affect your ability to buy more rental properties or more investments for 7 to 10 years. I mean, it's brutal. So we don't see that in the storage space. Another thing that I really like as well is storage has, very little management needed compared to, say, a similarly priced asset in the habitation space. Lenders really love it because it has a very low default rate, and in the very rare chance that it does default, it also has the lowest loss per default experienced by lenders. So it's a safe haven for lenders when the economy is, going to turmoil. I mean, anecdotally, when we were roaring in the middle of the pandemic, June 2020, August 2020, I was getting some of the best loans I've ever received on storage because banks were trying to flock away from assets that were crumbling in their books, hotel, office, lower class multifamily. And they were trying to balance out the risk on their portfolio by going into, say, self-storage. And the easiest way they can balance that risk is to incentivize more borrowing. And they do that by lowering rates and making terms better for those types of borrowers that they're looking for and the assets that they're looking for.
So what changes, if any, are you making now that loans are getting just a little tighter, interest rates are climbing? So what are you doing to get ahead of that?
Absolutely. So number one, we're lowering our leverage. So typically when rates go up, that causes liquidity to dry out in the capital markets. So, originally we were going to lenders asking for 80, 85% leverage on these assets. Now we're dropping that down to 65 to maybe 75, depending on if it's in a Class A area, if it's in a Class C area. The closer you are to Main and Main, the less of a hit that asset will take during a recession. So our Class A assets in primary markets, we dropped from 80, 85% leverage down to 70, 75. Our, lower class assets like Class B, Class C stuff in secondary and tertiary markets, we're dropping that down to like 65 to 75% leverage. Another thing too is, banks are concerned. So they are reducing the amortization schedule. So as opposed to, before we can get 25-year money all day, now we're getting 20-year offers. And the interesting thing with lenders is they have a limited amount of time. So it's not a ask for the world and hope you get something back that makes sense. Typically, they won't even counteroffer you. So say in this environment, I go to a lender, I say I want 85% leverage on a 25-year AM at a 4% rate. Instead of saying, hey, actually, here's what we can do, they say, actually, next. They throw that one in the trash and they go to the next file. So you got to make sure that you're making your request for loans in line with what the market's at. So now what we're doing is we're going to a lot of these lenders and we're saying, hey, we're looking for a 5-year balloon on a 20-year AM. I'm looking at 65 to 75% leverage, net worth well and exceeding the loan amount, and post-closing liquidity of 15 to 20%, liquid in a bank account. So that's one of the things that we've been changing in our underwriting, especially when we're going out for loans. Same thing on the other side with our equity investors that invest in our syndications. We're telling them, hey, there may be some turbulent times ahead. So we're stockpiling a lot of cash in case there is any opportunities to buy from those that did not heed these warnings and started to over leverage themselves. And now their loans may be coming due, or they're defaulting on certain debt coverage ratios on covenants that they sign, especially if they are variable rate, which there's a lot of variable rate storage out there right now. And then on the backside, we're underwriting higher cap rate exits. Not only am I a syndicator and I raise money from investors, but I also have self-directed money that I invest in other syndicators. And I can't tell you how many PPMs I've read where they're assuming 5 years from now, they're going to sell this asset at a 3.5 or a 4% cap rate. I mean, like, in what world? I mean, you're setting yourself up for failure here. You don't even realize it. And that's the death nail in the coffin for a syndicator, is to overpromise and then underdeliver.
Right.
Those investors will never give you money again. And the unfortunate part about good news and bad news is, if something good happens to you, you typically tell 1 or 2 other people. If something bad happens to you, tell like 10 to 100 people, right? So it's this nasty exponential spread of bad news, if you
Yeah.
will.
Yeah.
So we're making sure that we're getting extremely conservative on our underwriting, especially our exits.
Yeah, I was going to say bad news is the supernova of information.
That's right. That's right.
That's for sure.
I don't want to be a conspiracy theorist, but when you were going back to the mom and pops not being able to keep up with the moratoriums, when you look at everything that happened during the COVID period, the only benefit was to the larger global companies.
Right.
Those were the ones that were allowed to stay open. Those were the ones that weren't affected. If the smaller mom and pops can't stay in business, there's less competition for them now. And if you had to sell your asset, you had the larger companies right there to buy them up from you. So now they have a bigger market share.
You know, the unfortunate thing about the way our political system works is, you know, once Citizens United was passed and then some of these campaign reporting laws were passed, you know, now companies can vote with their checkbooks. And in some cases, they can even, the lobbyists for those companies actually will write the proposed laws. And then the politicians that have no time at all because they're taking meetings all the time, they only have a chance to skim through this 1,000-page document. They don't know what's in there. They don't have the time to read. So, you know, when you have these bailouts, if you will, they only typically benefit the ones that have enough money to buy those politicians. I mean, look at 07, 09. The bailouts of the too big to fail banks, they've been posting record profits from 2010 until today. I mean, it's, you know, the small banks, all those local banks, they got gobbled up. And now we see an even more consolidation in the banking world, which is causing our capital markets to be even more fragile and interconnected than it was before. So now those too big to fail banks are now too huge to fail, right? I mean, if you look at the consolidation in the last 10 years, it's been insane. And you see the same thing happening in all industries: multifamily, self-storage, office building, mobile home parks. I mean, this consolidation is continuing to grow. So only the people at the top really benefit.
Yeah. Yeah.
Fernando, thank you so much for taking the time. I know we've run a little bit long. We had some technical difficulties getting in, so I apologize for your wait in the green room, and we didn't have food ready for you while you were there. So again, our apologies. Hang on after we're done here so we can properly thank you. Folks, thanks so much for joining us on the Real Estate Investor Show, Hard Money for Real Estate Investors. We are Carolina Capital Management, lenders in the Southeast for real estate professionals. If you are interested in borrowing money for a project, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, go to carolinahardmoney.com and click on the Accredited Investor tab. Don't forget to like, share, subscribe, and hit the bell. And don't forget about Wednesdays with Wendy. We will see you guys next week. Have a wonderful day.